Hello, and welcome to Mortgage Modification Made Easy, what we believe to be the single most important product you can purchase to assist you in preparing for your modification like a professional. We've done many thousands of hours modifying loans, have learned how it's done, and have some good secrets we're going to share with you here. This is Mortgage 101, essentially the beginning, the boot camp of learning mortgages. I'm going to teach you as best I can how to do this process and find out if your loan can be modified and if you qualify. We're going to start with Chapter 1. And the first and most important question is, what is needed to qualify? We're going to cover hardship. You must have one to qualify for a mortgage modification. Owner-occupied. Non-owner-occupied properties can be modified in some cases, but for the most part, they're the most difficult type of mortgage to modify. We're going to cover 1 to 4 family houses. You can modify a loan if it's 1 to 4 family. If it's not, it may still qualify for modification, but again, it will be very difficult, the same as the non-owner-occupied property. In Chapter 2, we're going to talk about contacting the lender. There are certain things you need to ask your lender to help you modify your mortgage, and I'll cover in that chapter what you need to ask. In Chapter 3, gathering the correct financial information. It's important to have the right documents and submit the right documents when you are applying for your modification. There's an old saying, bad things in, bad things out. If you prepare properly, you submit properly, your loan will be much smoother on your modification. Chapter 4, determining the lowest potential payment. I'm going to start with saying don't ask why now. You'll understand later on, but it is important to know what the lowest payment is, and I will show you how to do that using the tools on the website. Chapter 5 is qualifying, by far the hardest chapter, longest amount of work. We're going to have to roll up our sleeves and we'll dig in there. Chapter 6 is following up and following through. I'm going to address what documents the bank's going to require on a regular basis. Unfortunately, you'll have to resubmit documents because documents will become dated throughout the process. Following through. Sometimes a modification becomes a very, very difficult and daunting task. I have had modifications we worked on for over a year before they got completed. Why? I don't want to make excuses for the banks, but the reality is that if you give up, you won't get a modification. So you need to set your sights on getting this done, and the final goal, if you get your loan modified, which you will, if you qualify, save tens of thousands of dollars over the life of your new modified loan. And at last, final modification. Sometimes they're easy to get to, sometimes not so easy. But if you have the proper guidance, which I'm going to give you, you will get to the promised land. Let's get started. About mortgage modifications is that you need to meet certain criteria to qualify for a mortgage modification. It can't be just that we want to pay less for our mortgage. We all want to pay less. The reality is under the government's program, you must have a hardship, the correct income to cover your new mortgage payment, and a lack of reserves. And they have to be a good hardship, provable income, and not that you just went and drew all your money out of the bank to qualify. We're going to start with a hardship. You must have a legitimate hardship to qualify for a modification. Meaning, generally a reduction in income is the number one reason for modification. Whether you're self-employed. If you're self-employed, you may have a reduction in business. Of course, you would have a reduction in income if that was the case. If you're not self-employed, you might have a reduction in hours at your job, or maybe your boss has just lowered your pay, or possibly removed your overtime. Loss of a job, well, that speaks for itself. If you're unemployed, of course, you're probably going to use the resources available to you, and hopefully you're receiving unemployment. If you're a landlord, or if you rent an apartment or a room in your house, even a bedroom rental would qualify as a loss of rental income, and that's a legitimate hardship. Perhaps you're married and your spouse no longer works, or maybe they're self-employed. If they're self-employed, they might have a reduction in income. If they're laid off, they might have a reduction in income, and those are legitimate hardships. Illness, and possibly you're sick, or God forbid, a family member is sick. If that's the case and they're unable to work or contribute money to the house, or the household expenses may have gone up as a result, that's a legitimate hardship. Adjustable rate mortgage, adjusting higher. If the payment's going up on your adjustable rate mortgage, of course that's a hardship. And last but not least, a loss of household income. That could be many things. Perhaps you had a roommate who no longer lives in the house, a child who used to help, a parent who used to help make mortgage payments. All of these would result in a loss of household income and therefore would qualify as a hardship. These are all your good hardships. Your bad hardships are pretty self-explanatory. A hardship is possibly a person who goes out and spends too much money, buys expensive cars, expensive clothes, and now wants help. Obviously that's not a legitimate hardship, and you'll probably be declined. Bad budgeting, just overspending your money, running your credit cards to the moon, going to Cali, to wherever for vacations, it's that sort of thing, all bad reasons. And as I said before, just wanting to lower your payments, not a good reason for a hardship, and you'll probably be declined. A common misconception with mortgage modifications is that if you tell people you don't make enough money, like the bank, that you'll qualify and they don't care how much money you make. It's not entirely true. You need sufficient income to cover your new payments. If you don't have sufficient income to cover your new mortgage payments, the bank is not going to modify your loan, not because they want to hurt you, but the reality is that you won't be able to afford your new property or your new mortgage, and based on that, you'll be declined. So let's talk about what kind of income you need to show them. You must be able to prove your income. If you're working for an employer and you get pay stubs, of course the pay stubs are what you would show. Oftentimes, last year's tax return and 1 or 2 months bank statements would usually suffice. If you work for somebody and are self-employed, kind of, and they give you checks, but they don't take taxes out, and they don't give you W-2s, technically you're a self-employed individual. What you may want to use if you don't own a company is you may want to use a job letter or something along that line. Joe or Joanne works for me, I pay them X amount of dollars per week, and then you would show them a couple of the checks to qualify. Leases, if you have tenants, and that's the way you derive your income, you could show a lease, or you could show what they call a tenant at will, which is a month-to-month agreement between a tenant and landlord. If you're self-employed, you are going to have to show them bank statements. You're going to have to show them a profit and loss statement covering usually 1 quarter. The bank statements are going to have sufficient deposits to cover the income you're saying you're making. So if you are going to tell the bank that you make $50,000 a year and you deposit $28,000 a year, well, needless to say, the bank is not going to understand that, and you're probably going to be declined. The reality is your cash flow and income and what you tell them you're making must be in line with your bank statements and your P&L, and you would have to provide the last 2 years' tax returns in most cases. Another problem is if you make too much money, you won't qualify for your modification because you don't need one. You're just back into this area, somebody who spends more money than they should and quite frankly doesn't deserve a modification. And last but not least is lack of reserves. If you have too much money in the bank, then of course you should be able to make your mortgage payments. And the reality is usually 3 months is the magic number. If you have less than 3 months payments in the bank, you'll usually be okay. If you have more, you'll probably be declined. So if your mortgage payment is $1,000 and you have $10,000 in the bank, you're probably not going to receive your modification. I'm not telling you to remove your money from the bank. Quite frankly, that would be fraudulent. But if you have that, you're going to have to wait till, even if you qualify on every other aspect, they're going to make you wait till your reserves have dwindled to less than 3 months to qualify for a mortgage modification. If you have a 401k with a lot of money in it that you can access, you may be declined. Or if you have an IRA with too much money in it, then you would probably be declined as well.